Good evening, everyone, and welcome to Admiral Markets webinar of 4th of September 2014. Today, Chris is with me, and we are going to talk about optimizing your approaches to exits for better trading results. So we will show you how to deal with exiting in the market, but also we will talk a little bit about your psychology, because for that reason, psychology is very important. I will take care of that, and Chris will be more technical. So, before we begin, our standard risk disclaimer. Online educational materials are developed by Admiral Markets as Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Risk disclosure statement stating all possible risks associated with forex market. By accepting the risk, you're also proceeding further with us. Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the authors, me and Chris, and in no way it represents the actual suggestion for the trade. These are not MUK's opinions, and the website in the video is not a .co.uk website, but a globalnews.com website. Forex is risky business, and this is a personal opinion only. This webinar is informational and educational purposes only. So with this having said that, we are ready to begin. So we are gonna mention psychology versus technicals, then ways to determine best take profit zone, scalping, intraday, intra-week, mid-long-term trading, trailing stop, yes or no. But the main accent on this webinar is, for my opinion, about psychology. This is what I will be mentioning, but the thing is, psychology is what ultimately matters, really, when it comes to taking profits. So we need to distinguish two parts of trading: fundamental trading and technical trading. Today, you could see we had strong impact news, and basically that was bid rate cut, which was unexpected. And you can see that euro dollar has dropped more than 200 pips. It will drop even more. Now that is the fundamental part of trading. Well, who knew that it would happen? Probably would have made millions today. But the thing is, we are mostly technical traders, and when we come to psychology versus technicals, it is a harder part, because for me at least, in this market, in order to short all of euro crosses, and I will do it 101%, I will short all of euro crosses. I don't care how many there is euro crosses. I will short every single of them. But before that, I know that it needs to retrace. Tomorrow there will be also a special analysis of me. I will get you potential entries on each single euro cross. So we might see what will happen. But this is now the chance for us to get a little bit more than we usually do out of this market. And this is now psychology. This is psychology. You can see that all of euro currencies have dropped like a stone, like there is no bottom. And the thing is, this is now psychology of the market. All of those who were long are closing their positions, thus giving a necessary momentum for all of euro crosses to go down. That is happening now, currently. It's happening. Now, the question is, where and will we short it? Of course we will. But first we need to get out of this psychology of masses. We won't sell it now because everyone is closing their longs and now everything goes down. So for us to be safe, we first need to get into retracement. After the retracement, we sell. Okay, so that is what also matters when we talk about ways to determine best take profit zone and how to optimize our exits. Psychology. This is very important. So taking profits is one of hardest decisions. You know about it. And I know that many of you, many times before, needed to make such a big decision as it is taking profit. When you are in profit, usually you don't like to take anything, you don't like to give anything to the market. So you want to basically trade as long as you can. And that kind of trading is dangerous because it can become greed. So taking profits is always about psychology. Yes, it has to do with our technical trading, but also it has to do with psychology. You need to learn about yourself, and because of that I will show you how market cycle of emotions reacts. So we need to watch the market cycle of emotions and avoid the spiral of doom if we want to be psychologically stable to optimize our exits. So optimizing our exits means that we are consciously getting out of the trade. In that state of mind, first, when you start a trade, this is the market cycle. You need to be optimistic, okay? Then there is another scale. You can be optimistic, content, and hopeful, eventually coming to a joy, which is something around there, but one step ahead is euphoria. Before the euphoria stage, you need to consider the exit. Because if you are euphoric, what will happen? Let's say that you have shorted euro around 31.20. And now you see euro is at 29. Now you're euphoric, right? And you can say, wow, yeah, great. I'm having really a great day. This is my best day for trading. Now I will leave the market. This will drop to 25. Many traders do that, especially novice traders, because they are euphoric, pretty happy because they made some money. I don't make any difference between this day and yesterday. For me, I made more money yesterday because yesterday I was trading. This day I took some few trades. GBPN long close for, I don't know, 15, 16 pips. Then I took short breakout trade and I was good. But I made more money yesterday. So why is that so? Because I'm not euphoric. For me, every day is the same. I just need market to come to me. When market comes to me, okay, I will take a part of it, usually, 80% of the time. So when you're euphoric, you tend to make many mistakes, especially when we talk about taking profits. Now, what did I tell you? Who's the man? Margin up for early retirement. Yeah, many traders do think about early retirement. But then market starts to retrace and your emotion starts to retrace also, because your emotion will start to retrace to this point. Imagine that tomorrow, I don't know, something unexpected again happens and suddenly euro climbs to 31.25. Now you're 5 pips in a loss. Believe me, those 5 pips, it's nothing to your account. But only yesterday you had 200 and more pips on your account. Okay? Now I'm 100% sure this will come to fear. What if it goes to 31.50? Then you're angry. Now we will talk about that spiral of doom. When you're angry, you will make revenge trading When you make revenge trading, you will lose. So your psychological profile would look like this spiral here. You should never allow that to happen. And because of that, you need to think that this day is the worst day to trade, even though if you made whole bunch of profit, then it was a day yesterday. Because yesterday we had couple of opportunities to make money. Today we are basically trading the chance. We were gambling. Now, who would have thought that euro dollar would drop so big today? Believe me, guys, no one would ever, if someone told me that this would happen, of course I would probably listen to him and probably made some I don't know, entry. But the thing is, if you made entries today on these market conditions, like this, trading euro crosses, then you were still here, close to joyful and euphoric. Maybe you have shorted after it dropped 50 pips. Guys, that isn't proper way to trade. Believe me, that isn't a proper way to trade. I will show you now upward spiral and downward spiral, and I will tell you a few things about this. I always talk about this when it comes to psychological profile. And I will take this example, taking exits. So this is resistance. This is support of your psychological scale. This is the same support as this one, and this is ultimate support. When you start to trade, you should start from these stages, because now treat this as basically support and resistance of your psychological scale. If you're buying off support, that will be perfectly normal for your psychology. It's same in trading. If you're buying from these points, you have better risk to reward and you have more chances to succeed. And that is the same thing with your psychology when you should consider exit points. So you start to trade here. Of course your profit rises, but also your psychological scale rises too. Don't forget about it. Beside your money, beside your pips, beside your profit, you're also rising in emotional scale. So your emotions rise to this point when it becomes dangerous not to take exit. If the price is close to first resistance, and you can see the price is very reluctant to break this resistance, but you also see that upward spiral is about to be broken. What you should do is to exit, because what will happen is this will happen. Euphoria will take you out, bang, you will go down, then your emotions will start to retrace as your account is retracing, because you didn't make any profits. Your emotions will come to this point. This is support. Now, if you are in a loss, as we talked in this point, then probably you will come to this point, frustration. You will be irritated because you didn't book your 200 pips of profit, but you let the market kill all of your profits and put you in a loss. So it's always better to take 20, 30 points in a single trade if you trade intraday then it's to basically gamble with your emotions. I just cannot imagine what would happen if tomorrow, again, an earthquake, I don't know, I hope that it would never happen, that earthquake, I don't know, happens in some important country, and let's say that euro dollar is going up, and suddenly from 29 it's 32.00 and you shorted it at 31.20. Yeah, I see a comment. Carlos is saying, that is exactly what happened me today. That is exactly what happened me today. And Carlos, I'm very sorry. I don't know why you traded today. I made a Twitter post. Saying that I won't be trading today, and I didn't make any trade analysis today. If you were following me, if you've been following me, just because I never make any analysis before such important news events. That would be very, I don't know, it's not professional for me to randomly take any analysis. I always take analysis when I see potential trade. That is the purpose of analysis. To give you the trend, to give you potential entry, to give you the potential exit, and to explain everything about trend, entry, and exit for that particular trade. That is the purpose of analysis. Today I haven't made any analysis just because I didn't know what would happen. What if we experienced not rate cut, but rate hike? Euro dollar would be 33 today. So that is why I don't make any predictions and analysis before those bid rate days and important news, so important news releases. Now, you know what I'm talking about, Carlos, because if you experienced this today, I'm very sorry for your loss. But that is, you need to be positive in that way, because you have learned something. You have learned that you should never ever do that. It's fortunate enough for you, Carlos, that you have me here as your mentor, me and Chris. I didn't have any mentor. I never had any mentor before. I am completely self-taught. Everything, what I do, what I did, what I've been doing is about me and myself. Every single loss which I have been experiencing in my career is basically gave me enough strength to constantly push forward and forward. And I have learned from my mistakes. That is why I'm suggesting always to consider your psychological profile. Many times it will happen that you basically are very, very positive, but you don't take any precautions to exit. You just do not want to exit because you're too greedy. You want to cover a loss. You want to cover up for, I don't know, consecutive losses. Or you need money, so you are gambling basically. Remember, guys, as long as your profit is going up, your pips is going up, your emotional scale will go up. If you start trading here, consider that you have only one more spiral to your psychological exit point. If it's in a confluence with the first resistance, let's say you're trading long, then get out or put a trailing stop somewhere around this level. Because if you lose, your profits will go down, but your emotions will go down, eventually putting you here, where you should avoid that at all costs. Okay? You should avoid that at all costs. Now again the question, good question. This is a good question. Again, everything I will tell you about my experience. Siachos. Why not follow the trend after the trade announcement? The rate cut was negative for euro, so it was obvious that it would fall. So why not to trade the news? With caution, of course, and only after the announcement. Yes, but did you see any retracement? I will ask you a simple question. If you want to trade short, is it better to trade here or maybe here at least? What do you think, Siachos? After the announcement, let's say you're talking about euro dollar. Did you see what happened? Price dropped like this. This is not tradable. You can take random entry, but that only corresponds that only explains to me that basically you will make that mistake once in your lifetime. And your account can be killed because you don't know what will happen. Always when you trade, you need to have a thought that you don't know what will happen. So you need to set a risk. Euro dollar fell 100 pips in a single minute. So would you take a short after it fell 100 pips? That is newbie mistake. That is only happening to traders who are new to this job. Taking short after it dropped 100 pips. No, you can take the short, it's okay, but only after it retraced. Not after it dropped for 100 pips. If you do that, then you're basically selling into support and you're risking your account. What would be your stop? 150 pips. For intraday trade. Believe me, I know what I'm talking about. I am profitable trader. But there were times when I was not so profitable. And those were the days basically when I started to trade. I lost my first account after 2 months of trading. Completely wiped the account. After that, I told to myself I would never ever let that happen to me again. And everything what I'm showing you and what I'm talking, I have the proof for it. This is my experience and this is my account. If I was not a profitable trader, if I didn't know how to make money, I should never tell you anything and I should probably not be your mentor, not be your teacher here. So if you would listen to me, never ever sell a single currency after it fell 100 pips in a single minute. You can make profits if you are lucky, but you don't want to trade luck. You want to trade the price, not the luck. Luck is reversible. 1 minute you're lucky, and the next minute you're here. So always wait for retracement before making any sell or buy trade. Except if you're doing breakouts, but today breakouts, I saw only one particular good breakout, that was GBP, other trades to the downside after it broke 50 level. It was clear that it will go down because all of those pairs which are correlated to euro dollar were going down. So today was not a technical day to trade. Today was fundamental way to trade. And if you want to connect fundamental trading with technical trading, then again you need to wait for retracement. If trend is down and you want to sell, first you need to be patient and sell at better price. So this was a little bit about your psychology. So the point here, what I was trying to say is, when your profits go up, your emotions will go up. Once your profits come to first resistance, which is important one, and that resistance cannot be broken, you will know that basically you're very happy, but you can be euphoric. So if you feel that is happening to you, these kind of things, you're pretty euphoric, go for exit or put a trailing stop. Don't risk reversal. So also, if we are talking now about technical trading, so this is about psychological way to exit the market. Now this is how to determine TP zones. This is technical now. So technically, it's very dependable of the system or method you are trading. So now we are talking about technical taking profits. So it's dependable on the system. My Camarilla MACD uses one kind of taking profits. Maybe your system or method you're trading uses other way of taking profits. The worst thing is if you don't know where to take profits, then you basically are not trading any particular method or system. I don't know what you're trading. You cannot trade a price without a method, because method is your plan, it's your tool to trade. You cannot I don't know, you cannot make a car, or you cannot make a tire, simple tire, if you don't have the tool for that, right? So the worst thing is not knowing where to take profit. Profit targets are not the same for traders who trade harmonics, price action, chaos, range bars. Each kind of that dimension has its own rules for taking profits. But ultimately, this is the first rule, your psychology, and then it comes to technical trading. So every single good mentor of yours should always tell you your psychology and technicality. So he or she should tell you how to trade and where you should take profits. Mentor which teaches you how to trade. Now, the additional problem is the pullback after the trade has gone in a profit, which may result in a break-even or stop loss being hit. That is what I was talking about. Technically, the price can go in your direction, such as was GBPN. I traded it, if you followed my analysis, I traded it 4 times in these last 2 days. 3 times I bought from 50 and 1 time I sold when I saw a breakout. But basically, I wasn't greedy. I saw that price is very hard to break 80 level on GBPN. And I was basically putting my stop somewhere below and waiting. If it breaks, okay. If it doesn't break, I won't be greedy. 20 pips in a single trade is good enough for me. Don't forget, guys, if you're trading intraday, not each day is like this today. Currency pairs do not move 300 pips each single day. Usually they move somewhere between 50 and 90 pips. Some pairs move around 100, 120, 30. Those minor pairs, GBP ODI, Euro ODI, GBPN. But mostly if you're trading major pairs, you won't be having many days like this. So think about psychology. Think about your system. Don't let that after that your profit goes in break even after 50 pips, 30 pips, or stop loss being hit. Market is a fast and furious beast, so you need to be very careful. Trading without stop loss, that is also important thing to mention. It can be profitable, but in the long run, I'm sure that your account will be wiped. So assuming that you have been using stop loss, as I always suggest, we might say that taking profits is also dependent on time frames being traded and trailing stop placement. Scalping usually means, if you scalp, guys, it's lower time frame, 1 minute, 5 minutes. It usually means taking 5 to 10 pips out of the market. Targets are determined by hourly pivot points, or very often as soon as the price makes 5 or 10 pips. It depends on the system. The system description would need to tell you how you should take profits and when to do it, in confluence with your psychology. Scalping can be turned into scalp swing and scalp swing into intraday. I already had a webinar about that. So if scalping is done M1 to M5, guys, do not go too much with your greed or whatever. 5 to 10 pips is the best option. Believe me, those time frames are very low. Scalp swings 5 to 15 minute time frames. Targets are usually 10 to 25 pips. So on 15 minute time frame, you can grab, if you know how to do, usually in between 10 and 25 pips. So if method allows you to scalp with 25 pip target, that is qualified as scalp swing. Intraday trading, it's usually done on 1 hour time frame, sometimes on 15 minutes. Now remember, 1 hour time frame, for me at least, is the optimal time frame for intraday trading. Intraday targets are bigger, and usually we use bigger pullbacks if we base trend trades. But targets are based not randomly as we talked here, 10 to 25, 5 to 10 pips. You don't look that on 1 hour time frame. If you trade 1 hour, remember, it's different than 5 and 15 because you don't think about 10 or 25 or 5, 10 pips. You don't think about it. You watch always your pivot points, daily pivots, historical levels, Kemeril, Amarimet, etc. Usually we use the form of daily pivot points because we are using a slightly bigger time frame, which is perfect for intraday trading. And of course, your, let's say the space from this point and this point is bigger than if you're trading 5 minutes. Usually when you start trading scalp trades, you will start here, but very, very soon you will come to this point. So let's say in trading terms, emotional guidance scale, trading on 5 minute time frame, from this support to this resistance is having approximately 10 pips, such as your target. But if you trade 1 hour time frame, you will start usually around here, you can come to here. So usually this is as big as 30-35 pips. And that means that you can try to take anywhere between, I don't know, 5, 10 to 35 pips. Why I say 5, 10? Because if trade goes, let's say in my example, if trade goes in my direction and I got 25 pips, I would never ever let the market have that. I would place my stop at 20 pips, break even plus 20 pips. But if I see that market is making 10 pips and then start to retrace, I don't know, in a drawdown, but then again it goes up, well, then I can consider 5, 7, I don't know, because market obviously is very hard to break this resistance, make new high, or maybe it's in a ranging mode. So then I can consider 5, 10 pips. But if I see that price is giving me the opportunity to trade bigger pip range on 1 hour time frame, of course I would be doing with 35 pips, sometimes even 60 in a single day. And this is dangerous if you start from this point. So 60 pips if you can have in a single trade, it's great. Even though 10 pips is good. But if you know when to exit, guys, many times the price will go up, hitting important resistance, and then it will reluctantly walk towards this resistance. Usually what happens is the price falls down That happened with GBPN. 5 times it was around 50-55 entry. Even maybe 10 times. This was good for buying. But then the price suddenly dropped and it was not good enough for buying. So don't let that happen to you. If you see that price is not making a new high and you are even 8 pips in profit, put your trail stop to break even plus 6. Maybe you will have a stroke of luck that this will soon become 20 pips, so you can put 16 pips to break even. But if you're not lucky, well, it depends how you take on the things. You can take even plus 6, but still you are not in a loss. Intra-week trading, I don't do that, but usually it's done on 4-hour and daily time frame. Stops are substantially bigger, and usually 1 trade per pair can be executed each week. Let alone long-term trading, because targets are usually random, 300 to 15,000 pips, depending on the pair traded. It's usually set and forget with occasional trading stop. I don't do it. So the table for optimum target zones basically tells you this. Strict TP means that TP should be respected to the pip. Set and forget. Observing price action means that you should babysit your trade observing price action around important support resistance level. Trailing stop is moving your stop loss after the given amount of pips. TP by heart is closing your trade and profit, not looking at strict TP or observing price action. Okay, so for intraday trades, we don't always use strict target price to the pip. We don't use set and forget, because sometimes price may come 1 point from our exit and then retrace. Observing price action for intraday trading, yes. Trailing stop, yes. And TP by heart, no. Only when you scalp and sometimes scalp swings. I can even take trailing stop on scalp swing, but only if I turn scalp swing into intraday. Watch about that webinar. Trailing stop. Some time ago I didn't use trailing stops. Today when markets are volatile, I'll advise using trailing stops. Trailing stop is an effective way to secure profits. And although it can lower your risk to reward because it's volatile market, a method which is 70 to 80% successful, you can basically lower your risk to reward if your method is 70 to 80 successful in picking up the entries and you have good psychology. So the optimum exit is solely dependent on the method you trade and what your mentor told you to do, unless you're observing price action, gut feeling, or discretionary method. So guys, always consider your psychological profile. Try to use lower targets. Don't be too greedy. Know your method. Use trailing stop. Don't use big stop loss. You cannot trade intraday with 100 pips stop loss. Optimum stop loss is 30 pips. Optimum, at least on Camarilla MACD. Stay out when day is full of news releases, such it was today. So this was my part of webinar. I hope you enjoyed. If you have any questions, do not hesitate to ask me. Now I will hand over the presentation to Chris, and then I will speak to you later if there will be any questions. So Chris, you can continue.
Yep, great stuff. Thank you so much. Let me make myself the presenter here. Sorry for that echo problem that you hear in the background. Still, this particular room is a bit on the empty side still, so, but there is more furniture coming later next week because I made a move. Let's see. Now you should be seeing the PowerPoint. Good. Well, what a fall it was on the euro. As T said, and what we've seen with others, it can be very dangerous. You know, from this point of view, it's good to stay out and just sit on the sidelines. It's interesting to see, though. Obviously, it's quite exciting to see it. As T was explaining, and then it was explaining in his PowerPoint. But for me, more from the point of view is that I was expecting kind of a euro-dollar, pound-dollar, dollar bullish trend. About a year ago, I was roughly estimating end of last year that it could happen in the second half of this year. So it's pretty cool to see in the euro-dollar indeed about July starting with a massive downtrend. So from that point of view, I was quite just, in awe of the downside here, the fall. And as Steve said, there should be more downside coming because with such a momentum burst to the downside, often enough this is just kind of like the middle zone within that downtrend. So that this is of course rough estimation, but yeah, I'm expecting definitely some good trends here on the dollar pairs for the rest of this year. I already expected that earlier this year, and with the momentum that we've seen so far, especially today, on top of it, we're getting a lot of confirmation of that. So it's pretty exciting to see the euro-dollar, as we've explained in the trading room, to break a rising wedge on the monthly and weekly chart and see it fall so impulsively. And with such a burst, I mean, there could be quite some bearishness to come. So very exciting trading times, I think, from my humble opinion. Anyhow, today's webinar is not about that. It's partly about that, but it's more about theory in a way that how can you optimize your approach to exits. Nenad talked about the psychology point of view. I'll talk indeed about more the technicals that are connected to how you can exit. First of all, explanation why exits are so important. Often enough, traders, as I've said more often, emphasize entries a lot, but do not look at exits. Whereas we're going to explain why exits are so important, tools for determining exits, and some other things regarding the timing of exits. So why is the exit important? Well, obviously it's the spot where we get a measurement of the success of the trade, whether it's profitable or a loss. So obviously it's the measuring spot that is the determining moment. You could actually, some traders, in theory, I mean, you really have traders that can almost enter at any spot. I'm not recommending this by any stretch, don't get me wrong. But you have some traders that are very experienced, can enter at almost any spot and still exit decently and avoid the trades that go against them kind of and stick with the trade that goes with them. I mean, you need a lot of experience, I mean, decades of experience to have such intuition and gut feeling that you could have the emotional, psychological capabilities to handle that and also keep the losses on the short side and the winners on the longer side. So it's really tough. But point is that if you have a great entry but you don't exit, you are too greedy, you are too hopeful, too impatient, or too patient, you're never ever going to get that profit, that exit that is good enough for the well-deserved excellent entries. So even a good entry doesn't necessarily lead to profitability. That's the whole point, basically. And a lot of that is psychology. So a lot of testing and work in entries, but not so much on exits. So what can we do on exits? It's only half the job, but how can we improve our exit strategy and our exit approach? This is a bit redundant. I already talked about it. Entry alone would be great, but it's bad. If the exit is bad, it's worthless. Entry could be horrible, but with a good exit, the trade is gold. Now, I'm not necessarily recommending a bad entry, don't get me wrong, but just to prove a point. For instance, here, with these pink circles, you see that these are very good entries, but if you exit it wrongly, it doesn't mean much, right? Well, the last one is not so good of an entry, but these first four are pretty good. But if you exit here, for instance, or if you exit here, or if you exit here, then it's really not that much of value. Well, I can give you another example, but I think you get the point. We're running a bit, we're having a bit of time constraints, so let's move on. Methods for exiting trades. It all depends, of course, how you approach trading. You could trade it automated, you can trade set and forget, you can trade set and forget until a predetermined moment, or you can do an active trade management. Active trade management means that you are actively moving a trail stop loss, you're actively moving a TP, or even actively hedging, for instance. Not necessarily recommended by myself unless you have a really clear-cut plan, but you're more active in its management. You just set and forget, of course, obviously, is you have the TP, you have the stop loss, that's it. Over and out. You know exactly where you're going to exit, either at the TP or at the stop loss. Active means that you can exit at any point, even with a market exit, by clicking it out. Now, clicking out, of course, has the disadvantage that you can do that at any point, and that is sometimes difficult to control from a psychological point of view. Set and forget until precedented element is where you basically say, okay, I will wait until a certain level gets hit, and then I actively trade management. Automated is everything is predetermined. So how you exit heavily depends on this. The advantages of automated and set and forget is that there's no time requirement. It's probably a bit easier on the psychology for some of you because of the fact that you just set and forget. You don't have to think about it. For others, it's more difficult. If you have the tendency to be more detailed oriented, it could be more difficult because you want to be more engaged. There are less options, which is a disadvantage because you cannot incorporate the new information into your trade management plan. Let's say you see a pin bar on the 4-hour chart. You cannot use that info if you have a set and forget. You have a set and forget, that's it. If you see a pin bar, that's tough luck. So the point is that the disadvantage is with actively trading management, you can look at info and use that info. Right? You took a trade at point A. Right? This is where you took a trade. But as time progresses, you get all this new info. You get all these new 4-hour candles. You get all these new daily candles, but you can't use them. Whereas if you use active trade management, you can use that info. Problem is that traders tend to use it too frequently, too often. Don't have patience enough for an active trade management. They are better probably with the set and forget. The disadvantage, however, as I said, is that you got all that info, but you're not using it, because you're just basing the trade on that one moment and the trades and the candles of prior to that. But all this new info, you're just saying, not looking at it. And that could be very useful info. It could be very beneficial info that you just ignore. So that's the disadvantage. R2R is probably a bit of an advantage because at least you have a very fixed R2R. But disadvantage is that you wouldn't probably get a big runner because you were not using a trail stop loss. So that is a mixed. Set and forget until predetermined element. It is a bit of an interesting mix between 1 and 3. You force yourself not to exit too early, but still benefit from certain elements of active trade management. Active trade management basically is more intensive, more time requirement. You have to be on top of things, keep an eye on the charts, can't go walk the dog and sit in the park as much maybe as with the automated set and forget. More options though, as I said, more active, more on the ball, but tougher on psychology. That's basically the summary here. So what are the tools for exiting trades? Static tools like support or resistance, moving the trail stop loss, for instance, are pretty commonly used, are pretty known. Fractals, maybe 2. Tops and bottoms, obviously. Fibonacci, even. You can put a stop loss below a 78.6. You can put a stop loss below a 61.8. Pivot points, for instance. These are all things that are static. They don't change. Static is, are levels that remain similar exactly the same, in fact, unless you could, for instance, move a fib, unless you discover that the fib is actually different, a different swing high, swing low, then of course the fib would move. But it's not going to move without you moving it. Whereas a dynamic tool indicator is something that automatically moves as price and time moves forward. So, that's the static one. And these are, I think, logical ones. Now, how you exactly incorporate that, obviously, depends on your psychology and your trading plan. What you can use sometimes is 2 levels away from current price. So if you have a fractal, for instance, here, and another fractal here, and price is going down, for instance, you could put it 2 fractals away and put the stop loss below the second fractal to give it more space. You can also use the immediate fractal, which is a tighter stop loss. You can also put the stop loss above the fractal, but then you're putting the stop loss basically in a spot where price could easily hit and still continue. You can also use multiple time frame analysis. For instance, if you are up a 2-to-1 R2R, you can zoom in from the hourly chart to the 50-minute chart to zoom in and tighten the trail stop loss on the lower time frames. You could still use the fractals, but not of the 1-hour chart, but of the 50-minute chart, thereby not giving too much space, too much profit back to the market. And that all depends on our psychology. We have to make an exit rule that matches what we're looking for. If you have problems with waiting for TPs to get hit and you get nervous for the TP to get hit and it misses by 2 pips, you might want to think about splitting the trade in 2 or 3 parts, having only 1 TP and the rest having 1 TP and all 3 having trail stop losses and 2 without a TP. So split in 3 parts, basically, like this, 3 parts, or how do I do that? 1, 2, 3 parts, 1 with TP, 2 without, 1 with all with a trail stop loss. Trail, how do I do a trail? Let me do this. I should have made some table beforehand. Sorry about that. Trail, trail, trail. And maybe the second part, you don't have a fixed TP as yet, but you are able to add a fixed TP when you hit a predetermined spot. This is a mixture of a trade management exit plan that might suit that particular problem of that trader, not problem, but weakness of that trader more, right? It could suit that trader better. And could solve some of the things that you might bump into. You grab profit along the way, but allow it to go for bigger runs, for instance, just to give an example. So it's important to understand what kind of strengths and weaknesses we all have and how an exit plays a role in that. What do you notice when you exit? What kind of things are difficult? What things do you bump into that you might think, okay, this is certainly a headache for me? And how can you solve that, basically? Well, these tools are kind of natural things you can use. Here are fractals and fibs, for instance. Ignore the moving averages for the moment. And this is where you can use to exit. For instance, here if you take the reversal trade back down, an optimal exit would be the 61.8 and the minus 6.8 confluence within the uptrend here for that reversal trade. Here, for instance, too, we got a downtrend in play. Price is retracing, and if you take the retracement off of the 886 fib, you might be aiming for the 50 and the minus 272 target, and the second part could be aiming for the 618 and the minus 618 target. Right? Excellent exits. Premium exits, I would say. And fibs, in that regard, are extremely useful for exits. But yes, sometimes when the market is a bit more aggressive and has a bit more momentum, like today, and if you are in a swing trade on the euro dollar and you're holding it maybe still from 130, I don't know, from the consolidation we had at mid-August, and you took a break at 133.50 and you're still holding it, by any chance, for instance, it's a big swing trade, obviously, then you would see probably price move beyond your fib target because it's accelerating in its speed. So obviously fib targets are great, but you will have moments that they move beyond that. Here again, you can use fib sequence number to get an idea where price could turn. Often enough, you see price stopping at roughly at Fibonacci sequence numbers, or you see that certain movements are equal to each other. This is a 50-minute world where roughly the first swing high is equal to the second swing high. And another way of optimizing exits, you can use the pivot points, for instance, to exit. A weekly pivot point, a daily pivot point, confluence between Camarilla and weekly and monthly pivot points. You can use bigger bottoms. These blue lines, for instance, represent bigger support lines, and price on this euro dollar wasn't able to break through it. So tools for exiting trades, dynamic, trend lines, moving averages, Ichimoku. These tools move basically as automatically as price moves along. And basically these tools are very useful for trail stop losses. Whereas the other tools are great set and forget tools or great TPs for someone who uses half active trade management and half set and forget, for instance, or half TPs. Mind you, within active trade management, one doesn't have to use necessarily trail stop loss. It could be half trail stop losses and half hard TP, right? So it could be a mixture in that regard. These dynamic tools are better for the active one. The set and forget are very useful when you use the static ones. And once again, I just want to emphasize that there are too many factors. I'm giving you kind of concepts and tools to think about with regard to exit management, because there are too many factors for each trader to consider. Because the best exit plan is one that is matching how your strengths and weaknesses fit together in your strategy. And there are too many variables to say this X, Y, Z is the best exit ever. Because the market is too variable and each trader has too many variables, all right? So that's why I'm not coming with a fixed formula. But here's the moving average, for instance, and you can see how a trail stop loss would work either by using fractals in combination with the moving averages or the moving averages themselves as a really, once price hits the moving average, that's it, I'm exiting. I don't use that style too often. I use more often fractals with moving averages. That means I use the fractals that are touching the moving averages as a trail stop loss, not the moving averages themselves. Here you see, for instance, let's see, the moving averages as a great guide for the downside. The trend lines are showing the break to the downside, and the moving averages are giving a great clue of when that downside has ended. And the AO could be a great tool as well to exit, by the way, if you're in a retracement trade, if you're trading the reversal, let's say from this green dot. Once the AO gets back to the zero line at this blue dot, well, it could be great exit moment to get out of that reversal trade, because the reversal didn't get anywhere. Look at that. Price went sideways. It made a bear flag. The AO is back to the zero line after a very strong down move on the AO. So, in that regard, it shows that the reversal trade would be very wise to exit. Same thing here. Reversal trade didn't go anywhere. Bear flag. AO back to the zero line. Probably a good moment to exit. Downside, 2. Momentum to the downside. AO gets a bottom here, and you start to see green bars. Well, could be a good time to exit here. Why? Why there? Because you preferably want to enter and exit at the best, not only the best prices, but also the best timing of things. Entering here and exiting here, in my opinion, is a lot better than entering at the blue dot and exiting at the blue dot. Why? Because we save about 1 day or 2 days of, probably a day, of staying in a trade that's not going anywhere. What is good about that is we have capital again to our disposal that we can use. We have book profit, and we can use that margin again for new trades. Maybe if we don't close that trade on the right time, the best time, we don't have the margin to take a new trade, and maybe whatever, that could have been a good trade again. So obviously best price, best timing. When you use the AO, you can have an idea of a decent timing, like this was the case where you enter here and exit here. Not only one of the best prices to exit, but also the best timing of things. And here's another example. And there are a ton of examples here of this moving averages that you can use to trail stop loss. Fractals with the moving averages as well. Now, obviously it's the best when you get an impulsive move. When you get choppiness, using moving averages and fractals aren't not that bad, but not that great either. Like this upside is great, but the downside, is pretty choppy. So you would get probably knocked out with a trail stop loss here and there. All right. Now I'm going to skip some of these slides because we're reaching the top of the hour already, but no problems. One thing I want to tell you about time factor. Not only the AO, actually I forgot to mention it here, but not only the AO is of great value for time factor, but the time factor rule of number of candles. Second thing, Lucas numbers, Fibonacci, time, and Gann. Now I'm not going to dive into that, but the number of candles is great valuable info in my opinion. When you get, for instance, a momentum, what is the characteristic of a momentum? That most candles make a new high or a new low. New highs and down uptrend, right? All these candles have higher highs, and most of them higher lows. Or new lower lows and lower highs and downtrend, right? Most of these candles have that. Not all, and that's the crucial thing. Not all of them have that, but when do you see the turnaround? Well, when I did research, I found out that 5 to 6 candles is a bit of the magical line. When a trend continues within 5 to 6 candles, it's still very impulsive. Here, 1 candle pause. Here, 3 candle pause. Here, 2, 4, 5 candle pause. Here, 2 candle pause. Here, 4 or 5. And then here, all of a sudden more. So in that entire downside, not more than 5 or 6. And where did you get the turnaround? Where you had more than 5 to 6 candles, not breaking this low, and then boom, upside. Keep that in mind with the exit timing. It could be a very important thing for optimizing your exit approach. If you're in a long from here and you see struggle with the pin bar and you realize that a ton of candles were not able to break this top, and on the daily chart, this is actually candle number 5, might be a good time to exit, right? So obviously it's not 100% rule, but I would say the accuracy is very, very, very good. Then we got some tools there's a separate webinar on time factor, by the way, so I'm going to leave it with that. I hope it's clear. If not, please ask a question through the chat. I'll be glad to go into your question, but I hope that's clear. Other tools for exiting trade is price action. Obviously, price action very important. Besides static, dynamic, and time factor elements that you can think about for exiting your set and forget or active trade management or automated system, you can use price action as well. Candlestick patterns, impulsive and correction momentum movements or non-momentum movements, chart patterns, and divergence. These are all very, very useful things. Candlestick patterns, I think, are logical. Impulse and correction, for instance, as I said, fast move up, slow move down. Chart patterns are triangles. You can use that to exit as well. If you have, for instance, a move up and you're taking a reversal trade, but you see a triangle, you might want to exit at the bottom of a triangle or at the break of the triangle to the opposite side. And divergence too, when you see this is a triangle, for instance, where you can think of reasons to exit. Triangle, exit at E, for instance, exit at D, etc. Flags, expanding wedges, double bottoms, flags, triangles, all of these examples here for such things. Now, with divergence, you're going to have also optimal exits optimizing exits, because if you see a grand rush like that, and you see the second bottom break here is showing divergence, and you got double divergence between these bottoms here, well, you might want to think about exiting a short that you took somewhere in here, for instance, because you're going to get a higher likelihood of retracement like you indeed saw here. Now, a single divergence is not always golden. You might want to see sometimes you might get double divergence. It also depends on the time frames. Multiple time frame analysis, higher time frames will often enough see bigger retracements happen. So this is the kind of a skill that you would have to develop to estimate when you would want to act upon the divergence and when you think you would want to exit on it. Not every single divergence on the 50-minute chart, for instance, needs to be exited immediately. In general, though, they're a pretty good warning of an opposite move to come, and by keeping an eye on them, you would, and especially if you have, for instance, a 4-hour double divergence and you have a single divergence on the daily, you could save a lot of headache by exiting relatively at the bottom and missing an entire correction to the upside. So I guess that's it. Yeah, here there's an example of a falling wedge. It's a chart pattern. There's multiple double divergence. Price is approaching a minus 618 target. There is a bigger daily uptrend on this daily dollar CAD at this time. And from this spot, we had a tremendous, huge momentum to the upside. If you had any shorts, obviously this was a good zone to exit. And you can see how you can combine all of the stuff that we discussed today to come to a confluence of reasons why roughly in this zone an exit would be appropriate. So, I could personally talk on and on about every of these situations, but with the time running out, I would want to ask you if you have any questions at the moment, as I can answer, or Nenad can answer any of that. Let's see, Lau has a question. Sorry guys, I'm out of the topic, but when is the time worth to use fib after the big fall? Second bull hour on Euro, what do you think? What time to use the fib after that big fall? Well, I think that we could probably fib the entire daily candle. I mean, it's such a big daily candle. It's almost impossible to see a break of that. I mean, in my opinion, couldn't imagine a break of today's future high. With a break like that, obviously it's going to be interesting to see where today's candle close is going to be. I don't expect too much of a bounce, roughly around 129.50ish, I guess, or shouldn't be much of a bounce, I would expect. It's difficult to estimate which fib. A 38.2 fib at 130.10 could be already a resistance zone for downside. We'll see where the pivot points are tomorrow as well. But from a fib point of view, it could be quite shallow. 130 is, of course, psychological support level, now broken, could be resistance. That's great, Morten. Good to hear that. Yeah, I hope that you can see the richness of tools and things we can use to get an exit. Obviously, the example I gave with the dollar CAD was very discretionary, and this is something that just needs time to get experience in it so that you feel confident in doing that. At the starters, probably it's better to have it a bit more non-discretionary to get more confidence in any approach you have. So that is always a wise thing to do. But I hope you have some good inspiration now to tackle the exits. Great stuff. Björn is asking if I've got a chart now. I do actually. It's a good idea. If you look at this downside, and it's so fascinating to see for me because I was looking at this rising wedge. I mean, this folks, you have to understand why I'm so enthusiastic about it. It's because this wedge has been playing out for years and years. So, that's why I'm pretty excited, because it's finally happening. That's why it's pretty just from that point of view. It's interesting. Here, let me pull over this chart here, and you can see. Let me refresh the template here. Monthly chart, and yeah, this wedge, right, an A, and this was the A, B, C, D, E of the wedge. And with that said, if this is the C part of the bigger correction, I mean, we don't know for sure yet, but it is moving impulsively, so there is a decent chance. Then we could potentially and maybe see the fall to these targets, 113 parity. It's too early to tell, but within the triangle, which is an A, B, C, D, E, and the E part was very slow and corrective, of which we had a three-wave move, of which the third move of E, this is E, sorry if I'm too fast here, but running out of time, E had a three-wave move, of which the third move, the green part, was kind of a slow upside rising wedge formation. So those are all characteristics that are showing that we could be seeing the end of the triangle, the end of the rising wedge, which ends the triangle of a bigger triangle. Sorry, the rising wedge of a triangle. And now we're seeing the impulse here, as we should see if that is so. So it's pretty exciting that indeed good impulse, correction, good impulse, but especially this part. So I would be interested to see tomorrow indeed. As I said, if you put a fib on this entire downside of this daily candle here, and put a fib on a daily candle, it's going to be interesting to see where the close is compared to the low. Wouldn't expect it too far, and if it's not too far, then 38.2 fib, 50 fib. If there's some good confluence, could be bouncing spots. Maybe not even that deep, by the way. It doesn't have to go that deep necessarily. We'll have to see how it closes, where the pivot points are, and how price action starts in the morning. Is my humble opinion, but this is my 2 cents, of course. So let's see. Tomorrow we'll know more. Also, NFP is tomorrow, by the way, so that's a bit of an unknown factor that we have to think about as well. Next week, we got live webinars, Learning Lab Monday and Wednesday with Tarantula, and Trading Lab with me on Tuesday, Wednesday, Thursdays in the morning. And take a look at Animal Markets social media as well. Take a look at their spreads here. And last but not least, I guess I'll just show you quickly the next week's webinars. Go to education webinars, and you'll see that next week we got the usual weekly recap, pivot points. Nenad's going to talk about scammers on the 10th. Then we're going to talk about next week Thursday, learning classical technical analysis, and premium webinar the 14th. All right, so thanks for staying overtime with us today. I hope to see you. Wish you good trading tomorrow. Be careful though with NFP. A lot of traders don't trade at all, just like the euro and pound interest rate today. So as Nenad said, it's very wise to take time off and don't even look and analyze on today and tomorrow when NFP is here. In any case, hope to see you next week with the webinars, and wish you all a good night. Cheers.
Cheers, everyone. Bye.